I'm Taylor Riggs in San Francisco, in for Emily Chang, and this is Bloomberg Technology. Coming up in the next hour, a record-breaking season. The holiday period proved gangbusters for online retailer Amazon, as the company says billions of items were ordered by customers. Plus, Apple, Tesla, Netflix. We've got Loot Ventures' Gene Munster with us. He'll talk his 2020 predictions. And a 2020 launch, Facebook's cryptocurrency Libra is set to debut next year. We'll hear how the head of Libra, David Marcus, and Facebook COO Sheryl Sandberg touted its big promise. But first, to our top story, record-breaking sales for Amazon this holiday season. The e-commerce giant posts its largest advance on the S&P 500 index on Thursday, a day after Christmas. Amazon didn't release specific sales figures, but its statement backs up broader reports that online shopping picked up this year. For more, I want to bring in Bloomberg Technology's Spencer Soper, and also with us, JumpShot CEO Darren Baker. Spencer, talk to me about what specifically we learned from Amazon this holiday season.
Well, in terms of their statement, we didn't learn much. I mean, every year's another record for Amazon and for e-commerce. But what we did see was that this was the first year, one, that they rolled out their one-day shipping pledge on millions of items, and also that they handled so much of their own delivery on their own. And so that's why I think a little bit of the boost is simply that Amazon got through Christmas without any disasters, because everyone was wondering how they would do this year with those two new things on their plate, and lessening the reliance on partners like Federal Express.
And Darren, you heard Spencer that every year is a record year. Is Amazon just riding the wave of e-commerce, or are they doing something special?
I think it's a little bit of both. So the Department of Commerce came out with a stat that said that e-commerce is up 17% year over year. That period that we call Cyber 5, in between Thanksgiving and Cyber Monday, was up 20% year over year. And Amazon is just dominating the holiday season. They drove 15 times more purchases online than the second biggest competitor, Walmart. So in all aspects, they are dominating this season.
Spencer, I think what was interesting, and if you come and take a look at a chart of Amazon inside my terminal, is really in the last quarter, it was sort of trading around that 200-day moving average, not doing a lot. A lot of this concern, I believe, from analysts was that heavy investment in same-day shipping, in one-day shipping. Was yesterday in this holiday season the clarity that analysts and investors needed, that investment is paying off?
Well, we know the investment is bringing in the revenue. We don't know how quickly the revenue is going out the door. So that's what we're going to find out in January in their report. We'll find out how, we know that they had another good holiday quarter. They sold a lot of things. Shoppers went to Amazon for their products. What we don't know is how much it cost Amazon to deliver all of those things, especially since they're doing so much of it on their own. And so that's the big million-dollar question now. We know Amazon brought in a lot of revenue. How much did it shove right out the door to pay for delivery?
And Darren, you've been sort of nodding your head. What is your take on the battleground that is same-day, one-day shipping? It was only, I feel like, a few years ago when two-day shipping was a big deal.
Yeah, I don't think Amazon really cares whether it's driving margin long-term, right? They cared about that a year ago when we saw results that showed the e-commerce business was highly profitable. They invested in one-day shipping because they know the next battleground is not holiday purchases, but the things you need every day. Groceries, the stuff you buy at the pharmacy. Those kinds of products are the ones that one-day shipping really satisfies. And I think with Walmart and other brick and mortar retailers investing in buy online, pick up in store, Amazon had to match that. They had to come out with something that trumped even the pick up in store by offering one-day shipping. And the more products they offer that on, I think the more of the wallet of the consumer that they're likely to get.
You mentioned some of those other retailers. We've seen quite a divergence this year. Target, Walmart that you mentioned, in many ways leading Amazon, at least when it comes to the grocery business. Other retailers, you look at Macy's, L Brands, for example, really struggling. Where are you seeing Amazon being a leader versus a lagger as it relates to brick and mortar in the e-commerce business?
Yeah, I think there's a couple areas. And I think the two you pointed out are the ones that are the biggest risk for Amazon. I think where they're becoming a leader is in offering other products to brands. So advertising and basically other ways to monetize all that traffic that's coming to Amazon. They're driving billions of dollars per quarter now through their advertising business. And if they can figure out how to hook that e-commerce experience into more of a Whole Foods experience, into more of that one-day delivery, then I think they've got a really good shot at taking a lead in the grocery space.
Spencer, you talked earlier about the reduced dependence on UPS, FedEx, and really focusing more on Amazon's own delivery services. What do we know now into 2020 about how much more they're going to be really reducing the reliance on some of the shipments externally?
Well, I think we're going to see more and more of it. Amazon basically is doing to the logistics industry what has happened to retail over the past several decades. Amazon wants to have its delivery operation constantly at work, just like a factory that's constantly working. They want to use that capital. They want to use their delivery machine constantly. Whereas logistics traditionally has been more of like a batch system, waves of things coming to a distribution center, waves of trucks leaving, and those trucks not going to the same neighborhood twice. Amazon's turning that model on its head. Amazon is sending multiple trucks to the same neighborhood. It's breaking a lot of rules in logistics. Sunday delivery was a very good example of that, where things were simply dormant on Sunday for most couriers, and now Amazon's saying, no, people should be able to get things on Sundays. So we're going to see them doing more and more because they have to, because the best way for them to lead that change is by doing it themselves and doing the things that other carriers are not willing to do.
Darren, you were writing in your note that it's not only about Amazon, but some of the downstream effects that they're having. Some brands are being very successful on getting their brand out on Amazon. Others, like Nike, have pulled out and say, you know what, we're good on our own. What brands are you noticing that are doing well and others that are better going it alone?
Yeah, I think that's the real interesting story. There's a million ways to quantify Amazon's dominance of the e-commerce category. The interesting question is, how are brands going to navigate this? And you've got Nike, who made a very stark decision to pull everything off of Amazon. There are only a handful of brands who actually can do that. We've looked at other brands at JumpShot like Lego, which is a really interesting story. Amazon doesn't sell private label toy products, but they sell a lot of toys. Lego generated over 2 million unique visitors and shoppers to Lego.com, which isn't the first place most parents probably think of going to buy toys. Half of the people who shopped on Lego ended up buying their product, that toy product, on Amazon. So if you're a brand like Lego, you have to have a dual strategy. You need to have your own website, and it needs to perform well for the consumers who want the Lego products. But you got to do everything you can to be at the top of the Amazon shelf, because that's where the majority of people are looking to buy toys.
And Spencer, outside of just retail, as you take a look at Amazon in 2020, what would be the biggest battleground for them?
Well, beyond e-commerce, you have the cloud computing, and so you're going to see more between them and Microsoft and Google. That's another market. Cloud computing market is just growing tremendously, and a big horse race in that to keep trying to gobble. And Amazon has a very early lead in that and is ahead of the competitors, and is trying to maintain that early mover advantage going into 2020 on this market that's just going to keep growing.
Spencer, we're also getting some news as well today that Amazon's Deliveroo deal going in for about $500 million or so is being scrutinized in the UK. Is there a real threat there, or is that just more antitrust chatter?
Well, I don't know that you can just dismiss it as antitrust chatter. Antitrust chatter keeps building and building and building, and that's the question: is where is this needle going to get red hot in the case? And prevent Amazon from doing some things that it wants to do. So I think that it's hard to dismiss it as just noise, given all of the attention on Amazon. And the other thing I'd note is that the folks paying attention to Amazon are getting smarter about it and learning more about its business. Where I think previously, if we go back a few years, I think a lot of them simply didn't understand it. And how do you regulate something that you don't understand? So the greater scrutiny is definitely a threat to Amazon.
Well, all things Amazon and the holiday shopping season. Thank you to Jump Shot's Darren Baker and Bloomberg's Spencer Soper. And coming up, we go through Loop Ventures' 2020 tech predictions with Gene Munster, what he has to say about Apple and Tesla in the new year. That's next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. Apple is likely to continue outperforming its mega cap tech peers next year. That's according to Loop Ventures. Gene Munster wrote that the iPhone maker could chase its 80% plus rally in 2019 with another 20% gain in 2020. To discuss this and all of the other 2020 predictions, it is Gene, and he joins us from Minneapolis. Gene, I want to come and take a look at a chart here that I'm showing inside my terminal. You know this better than anyone else. The share price, which is having a massive run up relative to the street, which actually hasn't caught up with the shares. Dan Ives of Wedbush also noted that $350 on the stock. So did you. Why is $350 your fair value?
Well, I think Taylor fair value is somewhere between $350 and $400. I wanted to have a target that I felt comfortable at putting out there as our prediction. So that's the 350 piece. It also is representative of a consumer staples company. Think of Coca-Cola or Procter & Gamble, those type of multiples, a 25 type of multiple. The 400 suggests a multiple similar to Facebook. Typically, Apple hasn't gotten that multiple because it's a hardware company, and investors for the last decade have been concerned about hardware companies and their sustainability. And so when we think about what the proper multiple is, I think that this view that a hardware company is in fact a great business defined by what is impressive cash flow. If you look at Apple, they generate as much cash as FANG combined. And so if we use that as the goal stick here, the cash flow ultimately should drive the multiple. I think it's safe. I think it's a fair assessment to give Apple a fair value similar to what Facebook would be, which you call it 33 times. That yields a $400 target. So to answer your question in the most simple way, 350 is based on consumer staples. 400 is based on a multiple similar to Facebook.
I wonder, though, as they become less and less dependent on iPhone sales as a percent of overall revenue, do you start to look at this company less as a hardware and more as a software, the services, the wearables business? What's your take on that?
Yes, the combination of hardware, it's not just hardware, it's the hardware, software, and services. Hardware is still going to be 75% of Apple's business next year, so this is clearly an important segment. But I think if you look at just how the hardware is performing, it's performing more like a services business. Essentially, we're starting to see some repeatability. About every 3 years, people upgrade their phones. Now we're starting to introduce the wearables piece. Obviously, the wearables segment is included in the hardware piece, but that's starting to take on characteristics similar to the iPhone around upgradability. Think about what's happened with AirPods. So the answer to your question is that you need to look at this holistically and how the products operate and how they impact consumer buying trends. And I think when we look at it through that lens, that this, in fact, is a hardware, services, and software company that performs like a services company. My view, just quickly, of this justification for a higher multiple took a large step back last year with the dip in the iPhone business. Essentially, it's going to be down, call it 9% for 2019. But importantly, this should rebound and kind of stabilize in this low, mid-single digit growth. And I think that will be reassuring for investors.
Gene, you mentioned the cash flow that this company generates. I want to fold that into some other income statement, balance sheet analysis, which if you come and take a look at a chart inside my terminal, is the cash outstanding, net cash, which is the cash minus the debt, as you know, $100 billion. What is the best use of cash for this company?
Best use is to continue to give it back to investors because I think that the stock is undervalued. And the company has so much resources to make some big acquisition probably is not the best use. And so they've talked about this, call it their net cash position, as you mentioned, is right around $100 billion. And their goal is to be net cash neutral, which means they need to give back. This is on top of the capital return policy that they've announced, is to give back an additional $100 billion. Now, that's a challenge because when you're generating $50 billion a year, that gets hard to knock that down. And they haven't given a timetable of when they're actually going to hit that target of net cash neutral. My sense is we're probably 2 or 3 years away. So the simple answer to your question is the best use for Apple Cash, even though it's not a glamorous use, is to be net cash neutral, because I think that shares, it will reward investors by doing that. If they use the majority of their cash, kind of that stockpile that we're talking about, to buy back stock, that in itself should generate about 7% upside to current Apple share price.
Gene, I want to flip to another stock, and that's Tesla. I've talked to 2 bulls and 2 bears in the last few weeks, and they all have come to the same conclusion that Tesla is all dependent on China in 2020. Is Tesla really set up in China appropriately, in your opinion, for 2020?
I would disagree with that, by the way. I think China's an important part. It's 11% of sales today. I think having China Gigafactory there is going to materially lower the cost of buying a Tesla for Chinese citizens, probably by somewhere between 15 and 25% because of the way the tariffs are structured and the transportation costs. So this is important that they're going to be manufacturing Teslas they just started in Shanghai. But that's not the whole story. I think that the whole story around Tesla, just to step back, we're believers in this. We don't have a specific price target. We think it's worth much more than the $77 current billion-dollar market cap. But as we think about how this story progresses, there is an undeniable truth around electrification and autonomy that Tesla plays into. To reach that undeniable truth, or we'll call it escape velocity, when you know this story is just going to work. We're not there yet. The stock would suggest that we're moving in that direction, but we're not there yet. To reach that, I think they're still going to have some bumps in the road over the next year. I think China is going to be a positive swing factor, but ultimately I think that this company has a much bigger ambition beyond China and essentially capitalizing on the 90 million vehicles sold every year and turning those into electric vehicles.
One of your other predictions for 2020 is the rise of the direct listing. If I don't have to raise new money, do you assume that we direct list instead of IPO?
Yes, we're expecting, that's the simple answer is yes, if you don't need to raise money in there. The late stage markets are flush with capital now. I think that there's an opportunity for, let's call it 3 direct listings in 2020. Essentially there was 1 or 2 in 2019. So yes, I think that this theme of direct listings is it's for real. I've seen through my years of being an analyst, other talk of other methods for companies to come public, and I believe that this will, in fact, live up to some of its hype. One important aspect, though, right now, the way direct listings are structured is the companies cannot raise money themselves. They can sell secondary shares, but can't sell primary shares. That means they can't bring money into the company to help its investment. Through the process of the direct listing. That likely will change in the next couple of years. Some of those rules will be relaxed, and I think that point, once those rules are changed, I think you're going to see a material shift to direct listings. That's probably 2 or 3 years away.
Loop Ventures, Gene Munster, always wish we had more time. Thank you for joining us. And coming up, mounting pressure to police its sprawling site and a massive content library. What lies ahead in 2020 for YouTube? That's our conversation next. This is Bloomberg. Increasingly impossible tasks for YouTube. The Google video giant spent 2019 answering critics with some of the most drastic changes in its 15-year history. And with each step, YouTube gave people more reasons to attack its freewheeling, user-generated business model. Joining us to discuss the challenges ahead for YouTube, it is Bloomberg Technology's Mark Bergen. Mark, as you take a look back at 2019 for YouTube, did they do a good enough job of policing the content, of working on their data privacy, as much as both regulators and investors wanted?
Yeah, I mean, the pickle that they're in is that regulators and investors want two different things. You know, regulators, and the FTC case as a really good example, you're seeing regulators now putting unprecedented pressure and forcing YouTube to change how it moderates entire site with kids, right? So they can't do any targeted, starting January, no more targeted advertising for any videos aimed at kids. I think investors, if you're looking at your investor in Google and Alphabet, you want YouTube to be a platform as hands-off as possible, right? This is a very valuable, especially with the streaming wars going ahead. YouTube as an advertising business is pretty phenomenal, but it has this major liability if the laws change. And so the investors, I think, they want YouTube to continue to be an open platform.
Talk to me about that liability. Do you see a time in the coming years when YouTube becomes liable for the content on their site?
So what's happening in Europe, and now there's increasingly talk in the Senate in the U.S. about changing some of the copyright rules, and that would mean that YouTube would, for instance, be liable for a music video or a video that's posted that violates a copyright holder. So that would be something that would have these huge both technical and legal challenges. There's a bipartisan push right now to repeal parts of Section 230, which is an issue for YouTube as well as Twitter and Facebook and any other user-generated content.
And as we take a look at 2020, do we think it's privacy issues or some of that content moderation that will be a bigger issue for the company?
I think that the biggest issue for YouTube is really going to, for 2020, will be around kids' privacy and how they're going to solve that. This is, we're expecting, they've told creators that, that some of the children's creators might lose a majority of their revenue. It's going to fundamentally change how YouTube operates in their business. It may change a lot of the content on YouTube, and going forward, the company is less liable, and the creators are going to be liable for privacy issues, but it's certainly something that regulators across the world are looking at more closely.
And Mark, quickly here, I mean, you and I have talked a lot about Sundar Pichai now taking over Alphabet and having more responsibilities than just the Google portion of the business. Any sense that he has a unique view on this or will take a bigger hand or a bigger role in this than before?
Yeah, so YouTube is one of the, they've cited, Google cited as the second fastest growth. It's certainly not as big a search as far as the estimates, but it is fast growing. Sundar, in a lot of his public statements, has talked a lot about responsibility, about content moderation, and certainly about sort of fixing their problem around kids issues. So I do expect it to be a big focus in 2020 as it's just an increasingly bigger part of Google's growth.
Bloomberg's Mark Bergen, thank you for joining us. And coming up, we will bring you the best of 2019, which includes endless Facebook coverage, our interviews with the head of Libra, David Marcus, and Facebook's COO, Sheryl Sandberg. That is next. This is Bloomberg. This is Bloomberg Technology. I'm Taylor Riggs in San Francisco. Despite losing 7 partners for its Libra cryptocurrency, Facebook got the remaining 21 to sign on the dotted line in October. Bloomberg's Kurt Wagner spoke to the head of Calibra at Facebook, David Marcus.
Towards the end of last week, there was a lot of pressure mounting, and I totally respect the fact that those businesses and those leaders have a responsibility to their shareholders, to their employees and stakeholders. And given that you don't need to be a member of the association to build on top of the Libra network, all of these companies will still have the ability to build on top of Libra. I understand that they don't want to do the heavy lifting by our side at this moment in time, and that's okay. We're going to move forward. We're going to add more members going forward in the next 2 quarters, and we're going to work really hard together to address all of the legitimate concerns that were raised by regulators and stakeholders around the world before this can move forward.
A lot of the companies that did leave, at least late last week, they're payments companies, they're financial services companies. Yes. Theoretically, those are companies that are familiar with the road ahead for you guys. Are you worried that they maybe know something that you're unaware of here?
No, and I want to strongly state that. I don't believe we're unaware of anything. I just believe that when your core business is in this space and you probably receive a lot of pressure not to press on, then at some point you have to make a decision on this high-risk project, because it's a project, it's an idea right now that we believe will see the light of day, but there's just a lot of hurdles that we still need to clear, and your core business. And again, you have to put your core business and your own business interests first versus a project like this that is high beta. And so, I understand that given that they're in the space, that they would, receive a lot of pressure and want to prioritize their own business.
I want to talk about some of that pressure. There was a letter that a few Democratic senators sent to a lot of these companies, basically urging them not to join the association. It read in many ways kind of like a threat. I'm curious, did you take it that way when you read that letter?
Well, I don't know. What did it sound like to you, Kurt?
It did sound a little bit threatening. It was if you don't, if you join, you're going to have a tougher road ahead. I'm curious, have you been surprised, I guess, by the pushback that you've received from regulators?
No, and again, I'd say that there are two tracks here. I'd say that there's the engagement on the regulatory front, where we've had very constructive conversations. There are questions; those are legitimate questions. We need to bring the right answers to those questions. Now we have the ability to do so. Since yesterday, we finally have a governance model and an association that is fully formed. It was really hard for us to speak on behalf of all of these prospective members before they became members. Now the association can take this on and really make progress on all of these questions. But I'd say that for these types of letters to be circulated for a thing that's an idea, a project, and telling people you should not explore innovation and a project at a time where not only here in this country but all around the world, the core of our financial system hasn't evolved much in the last 50 years, and consumers all around the world are paying the price for it. I think we should ask ourselves whether this is the right approach if we want to really lower cost and lower the barriers of access for financial services for all of the people who deserve so much better in the world.
That was David Marcus, head of Libra at Facebook. And in less than a year, Americans will take to the polls to decide their next president. And much like 2016, Facebook is under extreme scrutiny in how it handles misinformation and politicians lying on its platform. COO Sheryl Sandberg defended the social network at Bloomberg's The Year Ahead conference in New York in November.
This is a major test for us. Now we're building on, I think, some success. 2018, the midterms, we were very focused. From everything we know sitting today, they went very well. EU parliamentary elections, we've had lots of elections since then, but we know that this is a big one, and this is the highest priority for the next year.
And you've not been afraid of perhaps dancing with controversy to a certain extent, for what Mark and yourself have spoken very passionately about being, well, ensuring that the discord is there for those to be able to discuss. Talk to us about political ads and why you've chosen not to silence them, not to take them off Facebook, but actually still allow them to run, even if they may perhaps not be completely correct.
This is a really complicated issue. It is hard, and there are a lot of strong opinions on all sides. And I think we're trying to be very thoughtful on this. In the debate, I think there's some facts that are really getting lost. Okay. So one of them is that I think there are a bunch of people who believe that, things like the Biden ad that everyone was pretty upset about were only running on Facebook. That's not true. These ads are running on Google, on YouTube, across the networks. I think people think that we're doing this for the money. Mark said last week in earnings, we expect this to be 0.5% of our revenue in 2020. The controversy is definitely not worth it.
0.5%.
0.5%.
Okay.
And I think, and this is important, that some of the voices that are most concerned about this are coming from a place that they're worried that President Trump is going to use this in a way no one else can, and that he's massively outspending everyone else. That's not true. The Dems are outspending President Trump by a considerable margin. We believe political ads are really important. They're a part of political discourse. They're actually particularly important in local elections, in smaller elections, and this is important for people who are challenging incumbents. Elise Stefanik, who in 2014 was elected to Congress. She, Republican from New York, youngest female member of Congress at the time. She posted in the last week and said, I was able to challenge an incumbent because of Facebook ads. I couldn't afford TV ads. And that's why we're being thoughtful here and really trying to make sure that we allow this dialogue to continue.
That was Sheryl Sandberg, Facebook Chief Operating Officer. And coming up, despite its high price volatility, Bitcoin made strides in 2019. We'll hear from crypto bull Mike Novogratz from Galaxy Digital. That's next. This is Bloomberg. Bitcoin has fallen more than 30% since its peak in July. Around the same time, a battle over Bitcoin erupted on Twitter. The contestants, economist Nouriel Roubini and BitMEX co-founder Arthur Hayes. Bloomberg's Rashad Salamat caught up with both in Taipei.
Listen, it's been around for 10 years. 10 years, what are the killer apps in this space? There are none. 75% of these distributed apps, what are they? CryptoKitties, casino games, and literally Ponzi games.
What's going on here? He was questioning your finances, and you got rather fragrant with him, didn't you?
I mean, he's a hater. He's a no-coiner. He's been bashed.
A no-coiner?
A no-coiner.
Is that the new pejorative word for people who don't believe
Someone who doesn't have any Bitcoin and watched the price rocket in their face over the past few years. So,
it's a bit harsh, isn't it?
I think so, but I think it's true.
Now, I spoke to Mike Novogratz of Galaxy Investment Partners over the phone in July after Bitcoin's price slid after a brief monster gain.
Facebook is working on creating a stable, what I'll call a stable-ish coin, something to be used for payments. Currencies need to be relatively stable to be used. Otherwise, why would I spend a currency if I thought it was going to be worth a whole lot more in 3 months? And so you need lower volatility to be a payment currency. And so Bitcoin, I think, actually is legitimized by being a real hard asset. It's got a fixed supply. It's very difficult to change the rules around Bitcoin. And so it becomes like a digital gold. And people don't own enough of it yet. And so I really see the price going significantly higher over the next couple of years as everyone buys just a little bit of Bitcoin.
What is there? You say the price would go higher over the next couple of years. Do you have a call?
Like I said, I think if we can get to the old high by the end of this year, every Bitcoiner will be pretty happy. But once you take out 20,000, right, it opens up, 40,000 next and much higher over time. When I think about Bitcoin, it's probably got about $160 billion market cap right now, $150 billion market cap. Gold's got an $8.5 trillion market cap. And so Bitcoin has a long way to go before it replaces gold. And it has very similar features, right? Gold's got a limited supply. You can take all the gold that's ever been mined in the history of the world and fill it in 3 Olympic-sized swimming pools. And so that's kind of a crazy statistic, right? We could build a cube of gold in Central Park, and it would be worth $8.5 trillion. Hard to get your mind around, right? And we don't use gold for much. Jewelry, some, but most of it sits in vaults. And so Bitcoin, think about it as a digital gold.
That was Michael Novogratz, founder of Galaxy Investment Partners. Now, San Francisco Blockchain Week happened in November, and Cadena was the first blockchain technology to come out of JP Morgan's Blockchain for Excellence program. But there's still a lot of skepticism around the world of blockchain and cryptocurrency. To break down barriers and tout what Cadena is doing, Monica Quaintance, the firm's head of research and networks, sat down with me.
We are still in that phase right now where nobody's really sure what the correct way is to go from a blockchain starting at 0 to becoming a true decentralized network. But one of the ways is to get tokens into the hands of many people around the world so that they can then interact with and experience the network. And CoinList is really helping us with that. We're doing a sale through CoinList so that people all over the world can get access to the Cadena network tokens.
How has Libra changed the regulatory scrutiny around all of this?
it's really brought more energy and more people that before just thought cryptocurrencies and blockchain in general was so fringe, really into the limelight in a way that has actually been great for us, because people have started thinking critically about, well, if Facebook thinks this could be real, maybe it's not just some made up fringe technology, maybe this actually has potential. And all along, Kadena has been in the corner of, we think that blockchain is usable for business. It's usable for people to actually create resilient applications and transmit data in a secure way. You can track supply chains. You can track interactions between companies. We're right now working on a partnership with a company doing medical device tracking. And Facebook entering the arena has really, yes, it's brought more regulatory scrutiny, but honestly, more coverage from regulators that are forced to take this seriously maybe means that we might actually get some clarity.
We only have 20 seconds or so. So who is on our heels? Is it China?
Well, I would have said before last week that China was not a big player because they're so anti-cryptocurrency. But the president of China came out last week and actually said that he thinks that blockchain innovation is really important. So maybe we might actually see China being more open to cryptocurrency in a way that they weren't before, which means that the United States really needs to get their ducks in a row in terms of how they're going to treat cryptocurrencies going forward.
That was Monica Quaintance, Kadena Head of Research and Networks. And still ahead, a whistleblower speaks. One of the people at the center of the Facebook Cambridge Analytica scandal. Join me to discuss technology in a voter profiling age. Christopher Wiley on the risks ahead of the 2020 election. This is Bloomberg. Facebook lost an October bid to appeal a ruling that says its users can sue the social network over the 2018 Cambridge Analytica data scandal. Facebook had also agreed to pay more than $600,000 to end a UK probe into the scandal. More than 80 million user accounts were involved in that incident. Who better to talk about Cambridge Analytica than the man who blew the whistle on the company, Christopher Wiley. He's also the author of a book that details the whole series of events. Also with us was Bloomberg Business Week columnist Max Chafkin. I spoke to both in October from New York.
Before the story even emerged, I'd been working with law enforcement and regulatory agencies for months and months and months before the actual story broke. When Facebook found out that this story was emerging, something that they knew about Cambridge Analytica well before any of this was published. The first thing that they do is threaten the journalists of The Guardian with, in my view, a spurious libel accusation. It turned out that everything was true. And in my case, they went and banned me. They banned me off of Facebook, and they also banned me for some reason off of Instagram. And then after that point, working day in and day out with regulatory authorities in the EU, in the UK, in the United States, all over the world, one of the things that I really saw is just like the power that this company has to hide, to obfuscate their work, and things that one of the things that I came to sort of understand is that when you go and you blow the whistle, you see something that's wrong, and you report that to an authority. You think that there's going to be like some guy somewhere in some federal agency building that like knows what to do. And one of the things that I realized is that there isn't that guy. That guy doesn't exist. I've talked to governments, I've talked to regulators, I've talked to Congress, I've talked to parliaments. People do not know how to handle this problem. And for me, the real concern is that we have a completely unregulated digital landscape that companies like Facebook take advantage of. And even though companies like Cambridge Analytica now have dissolved and no longer exist, the capabilities are still there. And one of the reasons why I wrote the book was so that, to serve as a warning, because even if this company no longer exists, what happens if China becomes the next Cambridge Analytica? What happens if North Korea becomes the next Cambridge Analytica? And currently, there are no rules. We are entrusting our democratic process to a private company, and I question whether that's a good idea.
Well, Christopher, you mentioned that you're in conversations with lawmakers and other regulators, and I wonder if you think that the current regulation and current lawmakers are doing a good enough job handling the problem as you described.
Well, I think that one of the things going to Congress I realized was the power of lobbyists, particularly the power of lobbyists to define narratives. One of the first questions that I would always get at Congress is, can the law ever keep up with technology? And I would say, well, we regulate nuclear power plants, we regulate airplanes, we regulate, medicine safety standards. There's all kinds of technologies that we regulate in the name of consumer safety. Just because something uses software or is on the internet doesn't mean that we can't create rules that require companies to consider whether the products that they're putting out into the public will be safe for people to use. The United States is one of the only OECD countries, I think the only OECD country that doesn't have a national level privacy law. When you look at the language and the way that a lot of Silicon Valley companies, talk about themselves. They say we're a service, there's opt-in, there's terms and conditions, all this stuff. Yet, when you look at the types of people who work at the company, right? They're called an engineer, they're called an architect, right? They build ecosystems and environments. These are things that people are going into. These are architectures. And when you look at how we regulate physical architecture or engineering, right, where if you built a building, if you were an architect and you built a building without fire exits, and you said, well, it's okay because people agreed, they opted into my building, they walked in and there was a book of terms and conditions over there, and if it burns down, well, that was their choice. People wouldn't stand for that. And so I think that one of the things that I hope people, particularly lawmakers, if they read the book, one of the takeaways is we need to really understand what is social media. What are these platforms and their architectures, and they need safety standards.
That was Christopher Wiley, the man who blew the lid off the Cambridge Analytica scandal. Now, another Cambridge Analytica whistleblower, Brittany Kaiser, has a new role and mission after the 2018 scandal raised alarms about data privacy. We caught up with her in October in New York.
So since becoming a whistleblower, I have sought to explain to people exactly how important their data is. Data is now the most valuable asset on planet Earth, more valuable than oil and gas. And on a day-to-day basis, this is being taken from you by companies all around the world that are making a multi-trillion-dollar industry off of your most private information. Now, that sounds a little gloom and doom when people think that they can't get their privacy back, but the truth is people have agency. There's a lot of things that we can do on a day-to-day basis to protect ourselves, and legislators and regulators are finally listening. There are fantastic laws that have been introduced to U.S. Congress and across different states that not only could protect us ahead of the next election, but could make sure that we live a more ethical digital life from here forward.
So what sort of legislation do you think sets the highest standard at the moment? We've seen California pass privacy laws. You're working with Wyoming, but GDPR is something that Facebook itself has pointed towards in Europe as potentially being some sort of blueprint. Where do you think legislation is leading the way?
So I think with GDPR, the most important part of it is that it recognizes that your data is your property, and therefore you have the right to transparency. Who's collecting data on you, what do they hold, and what are they using it for? And if they want to continue to use it, you need to opt into that. Transparency and consent is the most important part of this conversation, which is why I'm really excited that the state of California has implemented a version of GDPR. That is going to come into effect in January. Also, Governor Gavin Newsom in the state of California has introduced something called the data dividend law, which means that not only do companies need to tell you what they hold on you, but how much money they're making off your data and give you a cut of that. There's also national legislation put forth by Senators Ed Markey, the consent bill, that means that we have to opt in as a nation. Right now, everyone in America is pre-opted in to your data being collected, which is the opposite in Europe. You're pre-opted out, and you have to actually consent, right? Now, also Senator Mark Warner has an entire package of legislation that demands everything from transparency and consent to how your data is collected to banning negative use cases of your data and malicious use cases of algorithms that push kind of hatred and vitriol to the top of your news feed on social media.
It's interesting that at the same time as legislation is being enacted, we're also seeing the companies themselves react in many ways. Facebook announcing that they are having more third-party fact-checking, they are employing more people, the amount that they're spending on security, the fact that we now see Google moving to protect children more with YouTube Kids. What do you think about the steps being taken by the companies themselves and whether they go far enough?
I think that the investment that Facebook is currently making into stopping foreign intervention in our elections is incredibly important and direly needed. Unfortunately, we didn't have those protections in 2015 and 2016. Unfortunately, what Facebook is not recognizing is that the greatest threats to democracy are domestic, to our politicians being allowed to say whatever they want in their political advertising. I think that decision a few weeks ago to not give the same community standards that you and I have to abide to politicians is not only a massive threat, but will continue the problems that we saw in 2016, where everything from incitement of violence, racial hatred, sexism, and voter suppression tactics were used by the Trump campaign and the Trump super PAC and aided by Facebook.
The fact that Facebook's own employees, some of them, have written a letter about this very nature, do you think that that might force some change? Do you expect that to have to be changed within the company, do you think?
I do expect that demanding change is the only way that we're going to get anywhere, whether it's Facebook employees or regular citizens. I tell people every single day, call your legislator. Sometimes I meet with legislators and regulators and they say they have never heard from a single constituent that they care about data rights, they care about data protection, and that is a big problem because if we in droves are asking our legislators, they are legally required to do something about it.
That was Brittany Kaiser, former Cambridge Analytica director. And that does it for this edition of Bloomberg Technology. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology. Be sure to follow our global breaking news network at Quick Take on Twitter. This is Bloomberg.